you need to find another one with a different approach. You can get a manufacturing with a published account or a partnership or a partnership. There is this one again. It is it was tested on April 2025. April 2025, there is a manufacturing of never limited question 5. April 2025, question 5.
2025, question 5.
You're there?
Yes.
So we have been told that Never Limited is a manufacturer of office furniture. The following trial balance was extracted from the books of the company as at 30th December 2024. Retained earning profits, direct wages, account receivable, account payable, bank, purchase of raw material, net sales, building in bracket the net book value, motor vehicle also in the net book value, office equipment, net book value, plant and machinery, net book value, allowance for credit loss, that is a provision for credit loss, or the provision for the allowance for doubtful debts. That's what the credit loss. The directors' salaries, inventories, selling and distribution, rent, office salaries, insurance, other indirect factory cost, electricity, general admin, different dividend, ordinary shares, and preferred shares. So this is it is a published account, but under manufacturing. It is a published account under manufacturing. It's a published account under manufacturing. Then we'll have to do another one because we have not done the published. So when we done with the published, then we can be able to do this one. Well, this one we have to reclassify the transaction, debit and credit, like expenditure, admin, we put separate, distribution, we put separate. So, which is our next question, our next topic. We go to that one. That's even the other one here is a manufacturing, but published. I want the one if we not published. So a good question. Yeah, there is this one too. There is another one here. Ama hii tulifanya. We did Kwanza Limited, right? We did Kwanza.
April question 3, 2024.
April? Yeah, that is for Kwanza Limited. is Kwanza Limited.
Kwanza Uroka.
Huh? It was Roka.
Yes. No.
It was Kwanza,
Kwanza, yes.
which I can see you and you. Try to find them out very fast. Any other yenye unaona ni manufacturing but haina mambo na dividend?
Question 2024. December, question 5.
December 2020. I can see there's another one, April 2023. You say December 20?
4, question 5.
First, you check the
Then,
requirement. It has, yeah, that one, it has, the moment you have seen, we have, yeah, this one, we don't have, yeah, you can do the event. Because we don't have, it is not a published. That is December 2024. Shanghai. So they have given us that Roga Limited. The following to balance was extracted from the books of Finance Limited, manufacturing company, as at 1st August 2024. Ordinary shares retain earning share premium bank, factory, plant, furniture, accumulated, inventories, purchases and sales, receivables and payables, allowance for doubtful debt, bad debt, carriage of raw material, direct wages, admin, electricity, maintenance, return outward sales and marketing general. Depreciation is provided. They've given us the rates 4% straight line, 20% reducing, 12%, 25 straight line. Furniture and fitting are purely for office use. Inventory was value based one, and then they're using FIFO. 200 units were produced during the year. Allowance for doubtful debt is provided at 10% between 6 months to 12 months at the rate of 25% on debt above 12 months. The data's aging analysis was as follows. What is the total value of receivables there? 5, you can see there. Goods are transferred to the warehouse at a cost plus of 20. Electricity, insurance, maintenance costs are to be apportioned. Anyway, we will do without apportionment.
okay.
Between the factories. No, this is not a publish, so this one is okay. Okay, it's not a publish. So you can now start with the manufacturing account. So we start by writing the name, Venus Limited manufacturing account. For the year ended, that 1st August 2024. The year ended at 1st August 2024, which we start with direct cost. Direct cost, we put the values in thousand. Put the values in thousand. So we start with, if we check the additional information, is there any direct cost? So So there is no direct cost in additional information. So we go direct to start with the opening purchases of raw material. Purchases of raw material, which we have it in the trial balance, 55,000. We add purchases of raw material. Purchases of raw material. Purchases of raw material. Purchases of raw material, which is 225,000. 225,000. And we have the closing stocks of raw material. Closing stocks of raw material. Before that closing stock, there is a carried in one. Add carriage of raw material. So there is a transportation of raw material. 7,500. There's closing stock of raw material in additional information number 2. 30,000 goes of zeros. So whatever we get is the cost of goods or goods of raw material available for consumption. Available for consumption. Goods of raw material. Goods of raw material available for consumption. $55,000 plus 225,000 minus plus 7,500 minus 30,000. So you're getting 227 500. Then we add other direct costs. We have other direct costs. We have direct cost in additional information. No? So we go to the trial balance, the direct cost, direct wages, direct wages is 120,000. Another admin maintenance, anything which is written direct, I'm not seeing it. So if you add, you get the prime cost. Prime cost. So plus 120,000. So we get 377. Yes, 500. And the prime cost. Then we add now other indirect overheads. Other indirect overheads. We add other indirect overheads, which we start with additional information. Number 1 is a depreciation is provided. Factory building, plant and machinery, you will always put it in the manufacturing account because plants are used in the factory. Plant and machinery. We always put in manufacturing 20% on a reducing. Multiply by the net book value of the plant and machinery. 200,000 is the cost minus accumulated depreciation of 20,000 minus accumulated depreciation of 20,000. So 200,000 minus 20,000 multiplied by 20. So we have 36,000. That's 6,000. What else? Now, if we go to note number number 6, electricity insurance and maintenance costs are to be apportioned in the ratio of 3:1 between the factory and admin. So we have electricity, we'll take the value of electricity in the trial balance, 20,000. So 3/4 multiplied by 20,000. 3/4 multiplied by 20,000. Giving us
15,000.
Insurance and maintenance. Is it one word? No. Insurance is a standalone. 3/4 multiplied by the value of insurance. 24,000. Give us 18,000. Maintenance cost. Three over 4 multiplied by the value of maintenance cost.
34,000.
Is it not 34,000? Yeah. Maintenance cost or maintenance and repair, right? They're calling
Maintenance and repair.
4,000. It's giving us 225. 500. And then, so I think we are down to the one which we have to apportion. Now, apart from that, do we have any other cost which is relating to the manufacturing? We go up in the trial balance, we follow down one. Factory equipment hire. Factory equipment hire. Factory equipment hire of 225,000. The 22,500. Then from there, you can get the gross on production, and then we add the other one. So let's get the total cost up to this part. So 377,500 plus that 6,000 plus 15,000, 18,000, 25,500, 22,500 to give us a total of 494,500. Then from there, we say it will less. We add the opening work in progress. add opening WIP work in progress in additional in the trial balance 40,000 less closing work in progress WIP in additional information number 2 56,500 6,500 so plus 40,000 minus 56,500 give us 47 7 478,000 478,000 so with 478,000 we add the manufacturing profit we add the manufacturing profit what's number 5 goods are transferred to the warehouse at a cost plus of 20% at a cost plus of 20%. So you see add manufacturing profit. Add manufacturing profit, which is 20% of this. 20% of 478, we get 95,600 to get the total cost of plus 478,000. So the total cost is 573,600. So that is the cost or goods transferred, the total cost to transfer to the normal trading account. The normal trading account. So there is no need even for the goods, the unit to produce during the year. So it's 200. So I don't know what was the reason for us giving us the number of units. And then they still giving us the total sales there. But anyway, you can get the cost per unit by taking the total production cost divided by the number of units. So that one will give you the unit or the unit cost. But these 200, they have given this one will help us to I've seen where we love to use it. Now let's get the cost per unit. Cost per unit. Cost per unit, you take the total number of the total cost, which is 573,600 divided by the total number of units they produce during the year. Divided by the total number of units they produce during the year. It's giving us 0.8688. So that is the number of units, the cost per unit. Now let's go to the normal the normal profit and loss. So we write Venus.
Kuna swali.
Yes.
So, while adding other indirect overheads, you only do depreciation for plant and machinery.
Yeah, you only do depreciation for the plant and machinery, unless examiner has given you a proportion like this for depreciation.
Okay. So for factory building and furniture fitting, hiyo itaenda kwa.
Yeah, it will go to the normal profit and loss.
Okay.
So let's the normal profit Venus limited statement of the statement of profit and loss. Statement of profit and loss for the year ended that 1st August 2024. So we start with profit or the sales. So we have sales 681 500 681 500, and then there is a return. I can see the return outward. I'm not seeing whether we have the return. And the return outward, but anyway, if you are just in manufacturing and the other one, you don't have any impact. Do we have the return inward? No return inward, so we go direct to cost of sales. So for cost of sales, we start with the opening, finished goods, opening finished goods, which we have been given in units. So the opening finished goods, we have 200 or 200,000 units with a value of 39,000. So we put 39,000, and then transferred from manufacturing account is we take the total cost 573,600 less we can take the return outward, less the return outward. We have to adjust in the manufacturing, but it is the same if you adjust even here, because we have not been told specifically it was the return outward for the materials. So 250 less the closing stock of finished goods. Finished goods. So closing stocks of finished goods is 160 units. So 160 units, 160,000 units, which will take 3 zeros. So 160 multiplied by the cost. The cost is equal to 0.2868. So we multiply by 160. or no, just use all the zeros to take out zeros times 0.2868. The cost per unit. No, this cost per unit, because we had other three zeros. So this cost per unit here divided by three zeros. Because this one we have already cut the zeros. I've already cut the zeros. So it should be we divide by 2,000, not 2 million. 553,600 divided by 2 million, 2,000. So it will give us 286.8, which should
Niko na
be,
swali.
yes.
Ukiangalia kwa trial balance, kwa finished good, tumepewa 200,000 units is equivalent to 39,000, si ndio? What if you like you say if that 200 be 39, what about 160?
Now, this,
Because that
no, you cannot do that because is this finished goods of 39,000 for the current year?
okay.
It is for the previous year. So if you do that, you are using the cost of 2023, not 2024.
Okay.
Yeah. So we multiply by 286.8. We multiply by 160, which will give us 4,588 as our closing finished goods. So 39,000 plus 573,600 minus 5250 minus 45,888 to give us 56. Yeah. We subtract. Okay. Subtract to get gross profit. So I take 681,500 minus answer. That's our gross profit. Now, let's less expenses. We start with the depreciation. Depreciation factory on a straight line. Factory on a straight line, which is 4% of the cost of the factory building. Factory building, if you take 175,000 minus 40,000, you remain with 135,000. The 40,000 is the value of the land, and the total value of the land and building is 175. So 4% of 135,000, getting 54,400. Furniture and fitting. Furniture and fitting, 12.5% on a straight line again. On a straight line, which is the furniture 120,000. So 12.5 we divide by 1,000, multiply by 120,000, giving us 15.